and it is a little bit concerning. The monthly CPI indicator rose 3.6% in the year to April 2024. It doesn't sound that bad as a headline, but when you have a look at the graph, it doesn't look that great. So we're all hoping, we being all of the Australian public and probably the economists, are all hoping that this would sort of drop a little bit to their 2 to 3% bandwidth. But it's stayed pretty consistent from December. So it's reporting in April. So we're kind of like 5 months where the CPI basically has stayed flat, which is not good. And it's the indicator from the previous year. So you got to sort of jump back to December 2022. So December 22 was the peak. Then it started to drop down a little bit. So we're now sitting in May. So May 2023, the CPI was at 5.5%. So we're now sitting at 3.6%. We're at 3.6%. This time last year, we're at 6.5%. It is a little bit concerning, and you'll probably see those articles that come up to say interest rates are going to keep going up and all that stuff. Hopefully that won't happen, but it doesn't look that great. The fact that CPI has leveled out again. So obviously everyone's worried about it picking up again. What I found most interesting was the biggest contributor to CPI. Housing rose 4.9% in the 12 months to April. Probably no surprise there, down from 5% in March. Rents increased 7.5% for the year, reflecting a tight rental market, blah, blah, blah. So you've got increasing rents, increasing cost of construction still. To a certain extent, it has slowed a lot. But it's kind of, we're in like this weird cycle at the moment where normally when they put interest rates up, it's because the economy is doing well. So when the economy is doing well, they put interest rates up to slow the economy. In this instance, they put interest rates up, and the effect that it's had for the last 12 months and every time they put it up is, as a landlord, you're going to put up your rent to cover the increased mortgage repayments. Otherwise, you're not going to be able to afford to have that property. And what's happened because of the lack of supply, as landlords, we're able to actually do that. Because there's limited supply, investors are selling up to owner-occupiers or other investors or whatever, and everyone's putting their rent up. So the people coming in to rent have no choice but to pay more rent if they want a property because the market's tightly held. So it's kind of like if they put interest rates up more, it's going to have the impact of putting CPI up with relation to at least housing. It will have an impact on number of new builds. So obviously the higher the interest rates, like we've seen now, the number of builds has decreased significantly. So people building new dwellings are taking a hit. You've got serviceability issues, as you guys all know. So it's kind of like a two-speed wheel. I don't know whether they're going to put interest rates up, but there could still be that possibility after looking at this. But I also think that now this is leveled out. Our interest rate reduction, which I was hoping would be in the last quarter of this year, and that's where all signs were pointing earlier in the year, that could easily be pushed out into next year now. So hopefully, fingers crossed, we don't get an interest rate rise. But it definitely, I think, is looking like we're not going to get an interest rate cut this year after seeing these numbers. So anyway, we'll see what plays out. I am optimistic that there will be a cut or multiple cuts into next year. It's just a matter of timing when those cuts will actually happen. So anyway, that's the CPI. If you're tracking unemployment, that's been notching up as well. So it'll be interesting to see how unemployment goes over the next month as well, because it shouldn't just be CPI, but that seems to be what the RBA is focused on, and everybody else for that matter. The other one is retail turnover. And my partner said to me today or yesterday, she's like, everyone's having a sale at the moment. Like all these major retail chains are having sales at the moment to obviously trying to get people to buy more stuff, and they're pretty substantial sales. And I said it's probably because retail trade is tracking flat, and also you've got the combination that it's approaching the end of the financial year. So all these businesses are trying to get you to buy stuff, all these retailers, because their turnover is lower. When you have a doubling of interest rates, and in some cases, if people are coming with fixed rates, even more than that. So when your interest rates double or triple, obviously we all have a lot less money to spend because a lot more of it is going onto the mortgages. So we're all tightening our belts and spending less in retail. And that's reflected here. It's basically just leveled out, even with, if you take into account inflation and you even track back to like 2 years, just about 2 years ago. So you account for 2 years of inflation and we've basically had flat retail volumes. So in real terms, we could be, if you do an adjusted figure, we technically would be 10% lower in terms of turnover by the time you account for inflation, of course. We would technically be circa 10% lower in terms of retail turnover. So over time, retail turnover should go up, technically in line with inflation if all things are equal, but that doesn't happen. When we all get money, we go and spend it. We're all the same. We spend a bit more when we have more, and when we have less, we spend less. So that's what's happening now. Everyone's tightening. Once interest rates start to come down, once the banking systems start to lend money more freely, which they're just starting to, but once that sort of plays out further, then obviously people are going to be spending more money, and this will spike, and the economy will go into hyperdrive again.